Every day, trillions of dollars move around the world silently and invisibly. Why do prices keep rising every single year without stopping? Do you actually know what happens to your money inside a bank? Welcome. Today we learn about the most powerful system in the world. The financial system affects every single person on this planet daily. Every card swipe, every loan, every purchase. The financial system is working. From biggest banks to smallest shops, everything is connected through one network. This invisible system controls how money moves across the entire world. Most people use this system daily, but never understand how it actually works. By the end of this video, you will understand money like never before. The financial system is a massive network that moves money between people. It connects people who have money with people who need money. Think of it exactly like a giant pipeline carrying money instead of water. Water flows through pipes to reach homes. Money flows through this system. Without this pipeline, no business could borrow, no economy could grow. Money flows digitally across borders, banks, and markets every single second. On one side are savers. On the other side are borrowers who need funds. The financial system perfectly connects these two groups every single day. Without this system, the entire economy would collapse within hours. This is why it is called the backbone of the entire global economy. There are four main key players inside the entire financial system. First, central banks. In America, this is the Federal Reserve Bank. Central banks control how much money exists in the entire economy. They also set interest rates that affect every single loan in the country. Central bank is the control room of the entire financial system worldwide. Second, commercial banks. These are banks where ordinary people save money. Commercial banks take your deposits and give loans to businesses and people. This simple function keeps money flowing constantly throughout the economy. Third, investment banks. They help big corporations raise billions of dollars. Goldman Sachs and Morgan Stanley are famous examples of investment banks. Fourth, regulators. Government bodies that keep the entire system safe and fair. All four players work together to keep the financial system running smoothly. The money flow cycle starts with you, the ordinary, hard-working saver. You earn money and deposit it safely inside your bank account. The bank does not let your money sit idle. It puts it to work immediately. A business owner applies for a loan. The bank approves it using your deposit. Your savings are now funding someone else's business dream and ambition. The business uses loan money to build factories and expand their operations. As business grows, it starts hiring more workers and creating new jobs. More jobs mean more families earning income and spending in the economy. Business succeeds, earns revenue, and repays the full loan back to the bank. Bank rewards you with interest payment for your original savings deposit. You earn interest, feel motivated, and deposit even more money in the bank. This powerful cycle repeats continuously, driving the entire economy forward. Interest rate is simply the cost of borrowing someone else's money. When you take a loan, you pay back more than the original borrowed amount. That extra amount you pay on top of the loan, that is the interest. Central banks decide the interest rate for the entire country's economy. When economy grows too fast, inflation rises and prices increase rapidly. Central bank raises interest rates, making borrowing expensive for everyone. Expensive borrowing means people take fewer loans and spend less money. Less spending cools down the overheating economy and controls inflation. When economy is slow, central bank lowers rates to encourage borrowing. Lower rates mean more loans, more spending, more growth, and more jobs. Credit means the ability to borrow money now and repay it later. When bank approves your loan, they are giving you their trust and credit. Debt is simply the total amount of money that you currently owe someone. Credit and debt are not bad. They are extremely powerful financial tools. A student with no money uses a loan to afford quality university education. They graduate, get a high-paying job, and repay the loan with ease. Credit transforms that student from poverty into prosperity and success. A business owner uses a loan to start their dream business from scratch. Business succeeds, creates jobs, and repays the loan. Everyone wins. But borrowing more than you can repay creates a dangerous debt trap. Credit cards, excessive loans, luxury borrowing, these destroy financial lives. Always borrow only what you can, comfortably and confidently repay on time. Financial markets are where money and investments are bought and sold daily. The most famous is the stock market, where company shares are traded. When you buy a share, you become a part owner of that entire company. Company performs well, share price rises, you make a handsome profit. Millions of people trade stocks every single day on digital trading platforms. The second market is the bond market, where governments borrow money. Government issues a bond, you lend them money, they pay you interest. Bonds are safer than stocks and provide steady, reliable income to investors. Third is the Forex market, where different world currencies are exchanged. Over $6 trillion worth of currencies are traded every single day. Forex affects everything: import prices, export earnings, and travel costs. Financial markets operate 24 hours a day across all global time zones. Inflation means the general rise in prices across the entire economy over time. Same product costs more this year than it did last year. That is inflation. One major cause is money supply, when government prints too much currency. More money in economy but same goods available, prices automatically rise. Too much money chasing too few goods always pushes prices higher and higher. Sellers see buyers have more cash, so they confidently raise their prices. Small inflation of 2 to 3% yearly is actually healthy for economy. It encourages spending, investment, and continuous healthy economic growth. But high inflation destroys purchasing power. Your money buys less daily. Hyperinflation makes money almost worthless, as seen in Zimbabwe and Venezuela. Inflation always hurts poor working-class families the hardest and most severely. Central banks fight inflation by controlling money supply and raising interest rates. Let us quickly recap everything important we learned in this entire video today. Financial system is a network connecting savers, borrowers, banks, and governments. Four key players: central banks, commercial banks, investment banks, regulators. Money flows from savers to banks, banks to businesses, back to savers again. Interest rates control borrowing, spending, inflation, and the entire economy. Credit and debt are powerful tools. Use them wisely and always responsibly. Stock, bond, and Forex markets connect investors with global opportunities daily. Inflation silently reduces your money value. Understanding it protects your wealth. Now you understand finance better than most people in the entire world today. Please like, share, and subscribe for more powerful educational finance videos.